mortgage stress tests aren't doing as much these days to prevent worst case scenarios for the Canadian banking system. Last year at this time, mortgages were still stress tested at 5.25%. But as you know, variable mortgages are well over that now and might go even higher than that. Because of this, OSFI is now trying to toughen up regulations. And in fact, this month, they released a list of potential changes to tighten bank lending, likely by Q3 of this year. So what will happen? And more importantly, what might this mean for Toronto real estate? Well, keep watching because I'll be talking about it right after this. This is a heads up that you can get our complete Toronto real estate investing guide for free on our website. You can see things like a breakdown of typical costs, rents, appreciation, sample financials that you can change up to see how it affects your returns, and even try out a quiz to see what might fit you best. I'll put a link to the free guide in the description below. Don't forget to like this video and subscribe to our channel so you don't miss other content like this made just for real estate investors in Toronto. Let's take a look at how mortgages have changed over time. The B20 mortgage stress test guidelines that we're using right now were first introduced in 2012. And back then, stress tests were only applied for those who were putting down under 20%. Now, Toronto real estate was on another steep trajectory up in 2017 and then crashed. And from that point on, OSFI decided that lending rules needed to be stricter. So in 2018, stress tests started being applied to all mortgages. The stress test rate kept changing over the years. It was 5.19% in 2019 and then dropped to 4.79% in 2020 and then came back up in 2021 at 5.25%. Now, how it works is that all existing debt that you have currently is calculated at actual rates, and the new mortgage that you're applying for will be stress tested at the higher interest rates. But even with the higher stress test rate, prices kept ballooning throughout COVID, and now OSFI is actually going to be making more drastic changes to change lending rules. Right now, they've suggested proposed changes and are now opening up the stage for feedback until April 14th. And then, based on feedback, they'll likely be implementing some of those proposed changes probably closer to Q3 of this year. Now, the biggest risk for banks is definitely rising interest rates. This risk is elevated for variable mortgages, non-mortgage loans, and also shorter-term mortgages. Take a look at this. Those who got an $800,000 variable mortgage starting at 1.75% that had a trigger rate were paying $2,855 per month. But nowadays, they're paying $3,739 a month. So that's a 30% increase. But this increase is actually lessened because they were paying a portion of the principal back each month and the trigger rate acted as a buffer. But for other types of variable mortgages and HELOCs, this increase is actually even more. And then there's also the renewal risk that applies to all mortgages, but it is higher risk for shorter term mortgages. Basically, if someone locked in a short 2.5% interest rate 1-year mortgage and then suddenly rates spiked to 5.5%, then that ends up being a huge 43% spike in monthly payments. So the first thing OSFI plans on doing is to make major changes to the way stress tests are done. For example, they might consider putting in tougher stress tests for variable mortgages, shorter-term mortgages, and non-mortgage debt like HELOCs. They might also look into making it harder for people to borrow bigger amounts of money, like putting in tiered stress tests, capping the amortization to increase mortgage payments of existing debt used for stress test calculations, using higher rates instead of actual rates to calculating existing debt payments, or possibly asking for a bigger down payment percentage for those who have more debt or are looking to borrow more debt. Now, one big risk is the impact of rising rates, but perhaps another bigger risk is the impact of too much leverage in rising interest rate situations. Basically, with the current stress tests, borrowers are able to rack up a lot more debt when interest rates are low and their debt to income ratios look much better. When that happens, they'll be at a higher risk of non-payment and default when rates rise, which is another big problem. So if OSFI thinks that this is a big issue that needs to be addressed, we might end up also seeing a new stress test that looks at the total loan to income on top of the debt to income stress test measure right now. And if you think about where all of this is going right now, you'll start to realize that most of these changes are going to make it harder for those with existing debt to borrow more money. And that just means that it's going to get harder for real estate investors to scale in the future. In the short term, once more people start to digest these potential mortgage changes, and once we get more clarity from inflation, GDP, jobs data, and where interest rates are going, then this might actually cause investors to push forward their purchases to Q2 of this year, 2023, to be able to qualify for more before stricter lending kicks into effect. This might end up aligning with the time that we expect more overstretched homeowners to have to sell, and so both of these factors together might mean a pickup in real estate activity probably in Q2. But in the long run, this will slow down the pace of growth from investors, and end users with no debt will be the ones with a huge buying advantage. Demand and higher growth will funnel into starter home markets, and the investment markets that overlap with these starter home types will benefit as well. And so, if investors want to scale and grow their real estate portfolios, they will have to be a lot more strategic moving forward. Buying condos won't be such a great idea because if you're looking to scale, the lower rent yields will cap your future buying power pretty quickly. What would make a lot of sense is to choose multi-unit homes with better cash flows, and then doing more things like adding more units, adding an extra laneway suite or garden suite, and these would be the ideal recipe to improve stress test ratios and end up making it faster for you to scale and grow. Now, because we know at least one or more of these mortgage changes are likely going to happen, it's pretty important to plan out your roadmap if you are thinking about investing and scaling in real estate in the long run. And so if you are thinking about buying this year and looking to scale in Toronto, and you want to talk to a real estate investing expert about what you should do, let's chat. We're a real estate sales brokerage that focuses on investing in houses and multifamily homes in Toronto, and here's how it's like to work with us. First, we'll do a discovery call with you so we get to know each other more and help you get your financing ready, and then we'll teach you how to analyze deals. Once you're set, our sales team will work with you to find the best opportunities on the market and eventually help you buy the best one for you. Houses typically need a bit of renovations, and we'll help you with a detailed scope of work and contractor connections. And then once you're ready to rent out the place, we also have leasing and property management services if you need it. So if you want to learn more about any of this, just head over to our website at the link down below. Again, don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. You can also head over here to check out our other videos. Thanks so much for watching, and see you in the next video.